Okay, there we go. Sorry, there for some reason there was no audio at that time. Anyways, I was looking at the S&P 500. That's what this is. What we're looking at now, and I noticed that it made a huge run up on the hourly right today. So, what it did is it did break structure. You just broke structure on the swing high. That swing high that is, as you can see, there's a swing high right here, right? And that is where you would see liquidity be in the form of sell limits, right? Now, when it jumps up and it bumps up here, you also have to look left to see where it was before. Now, it also was at the bottom of this wick here, right? You see this wick? That was on the 1 hour. So if we were to go in a little bit closer on the 15-minute, guarantee you we would probably see uh, some something a little bit easier to spot, easier to understand as to why it did what it did. Okay, there was really no fair value gap as to looks like the those two candles were actually touching. So there, it looks like it was even, um, or evenly dispersed, and there was no imbalance. But if we keep pulling it further left, then we get to right here, right? So that would be um, your last, and probably actually the body right there, the body of the last down candle before the next up candle comes up, closes above it, and that starts leading the succession that that closes above those equal highs, right? So that would be the areas to where smart money, right? So these would be equal highs. That would be where the liquidity lies, right? And this last bearish candle would be where smart money would push down to try to get people to sell before it finally pushed up, then came up equal to it and had a little bit of a retrace before it zoomed back up and broke that and took everybody out with it that would have been selling short. So most retail traders would have saw this line right here and would have said, "Hey, this is an area to where you could short sell." Why? Because it looks like there is a lot of resistance here. So a lot of retail traders probably had something like this on their charts, right? Whenever it came back up there. And so when it fell back down, they probably felt like they were winning until all of a sudden, boom, it turned around and shot back up really quick and then took them all out. And smart money took their money, basically, um, because it's kind of what happens whenever you lose your money. It gets handed over to the broker. The broker hands it over to the winner, and they take their part of the deal. So, uh, looks like that's what has happened here. And as it comes up and it makes these highs here, these equal highs, right? You also have some fair value gaps happening in here, right? Um, in the 1 hour. Let me go ahead and put the magnet on it. So you have the 1 hour fair value gap here, and then you also have a 1 hour fair value gap here. So you have two 1 hour fair value gaps kind of in succession, right? Moving all the way across this chart. And this is going back to, just a couple days ago in September, as it looks like, it looked like the stock market was probably in a panic and was going to fall. And what did it do? It came down and fell inside of a fair value gap. Again, this is why I always stress on fair value gaps, that these are they're almost like magnets, that attract price, but as soon as price gets, into them, and then maybe gets back down into halfway or more, then that's probably the last you'll see of it in that fair value gap. So as we go over here, I want to see where this fair value gap, if it was a 4-hour fair value gap, a 1-hour fair value gap, a daily one. Let's see what it was. Yeah, it was a 4-hour. So it was a 4-hour fair value gap. So I came back down and touched the top of it, and that was it. There was no more entrance into this 4-hour fair value gap. So I want to make a note of this. 4-hour FVG. Right? So, and then of course it takes off and creates another 4-hour fair value gap, which of course then it does pull back down into, and more than halfway down into. And here you can see where, and even here and here, it does the same thing. But as it's falling, it's doing the same thing. It's going right through it and then pulling back up into that fair value gap. So it's kind of filling in that imbalance that wasn't there before. Same thing with this one. Looks like there was a huge 4-hour fair value gap here. May have had people thinking that, hey, the S&P was on its way up. To me, if I would have saw this, I would have said, nope, this is coming back down. Even though it looks like there was some kind of consolidation just to the left of it, it doesn't matter. Whenever there's that big of imbalance, price is going to want to come back down and fill it, right? Not only is it probably going to want to fill it coming down, but it's also going to want to fill it coming back up, right? So now that one's over, and that goes for the same for these other ones too. So now that it's created this one, I have a feeling it's probably going to want to try to come up and fill this and do the same thing. Fill it coming back up, and then probably fill it coming back down. But then also probably try to come back up again, right? Because there is here up at the top what I would consider probably what we haven't seen in quite some time. A very nice liquidity point. Even though it did drop down to about almost 3,600 or so. And let me see if I draw a fib. Where would that take us and leave us? Let me see here. So it would drop down into the smart money buy zone, is where it would. So that doesn't surprise me that it ran up. And let me see where it got with this this area over here. So it ran up here, got about as high as here. So there's a fair value gap right here. Another fair value gap right here, right? Which is odd because look at these equal lows, and then boom, it just drops below it. That just shows you that it's just anybody who thinks that equal lows is a definite support are not thinking things through correctly, because smart money will definitely push down through that and take those people out, because those people are thinking one thing, and they're thinking, oh, well, look at this. I have two equal lows, so therefore, the next time it comes down to it, I can put in a long, and it probably shouldn't get any lower than that. I can probably aim for, maybe a little bit higher and take these guys out. Maybe what is this, a 3-to-1 scenario. And then as soon as you think that, boom, it goes against you. You're knocked out immediately. So as soon as you see equal lows, don't even think that. Automatically assume it is going to go against you, right? And then think about where the next point is below that it's going to try to get to, which would be this. That is the next low point that it would try to get below, because that would be the next area to where people would think there would be support, right? So, an area to where people would think that would be support, a long position here. This is exactly what people would be thinking. All right, well, it's going to come down here. It's probably going to hit this, and then run back up. I can probably have a short stop loss. I'll be saved. Of course, nope. I mean, even if you tried to give yourself quite a bit of room, and I'm talking quite a bit of room anywhere that, I mean, that's over 200 points right there. That is a lot of room to try to save yourself, uh, and it still fell below that, and then came back up and got there. So these are the things you got to watch out for. So if something like that happens, I would wait until you know for a fact it is done. How would you know what it's done? Well, until it breaks, until it breaks structure, basically. And again, you can look up that super order blocks indicator that I have. I just turned it on. There we go. And it will show you where the break of structures are, where the fair value gaps are, where all that good stuff is. So if I was to stretch this out, right, and then you can see here down at the bottom, it goes up. It's not showing it as a break of structure, because it's at this point, it's thinking the break of structure is probably below and not above, right? So it does come back down, hits again. Now we see we have a rejection block, right? So then it comes down, hits rejection block again, and now we have two equal lows here, both within the smart money buy area, right? Then it comes back up, almost equal highs, pulls down just a little bit, and then boom, takes off up above that. So here's where it breaks this structure here, gets into this fair value gap up here. That's where it was looking to go toward, right? It was looking to go toward this fair value gap right there. All right. So hold on, let me see if I can add something else in here. Window capture. Okay. And then, sorry, it's taking me just a minute to find this. Oh, that didn't work. Okay. It may be a little off, but hopefully it does work. It's actually not even showing up. Oh well. Yeah, it's not showing up. Okay, anyway. So then, now that it has got up in here into this fair value gap, fills it up, right? Like I said, it usually fills it up on one side and then fills it back up on the other. And then that's when you'll see it either continuously move up one way or the other, depending on where we are at in the formation. Here, considering we have broken structure on the bullish side, it has continued to move bullish. Consolidation area, boom, comes up, hits the same consolidation area, but then it manages to push itself above that consolidation area, right? And get back into, even though it's not drawn all the way across, except for this one, these fair value gaps. That's what it's looking to fill. It's looking to fill both of those fair value gaps. So if this was drawn all the way across, like that's one thing that's one thing I don't like about this indicator, or not even really indicator, more like a drawing tool. Um, is that I like to draw my fair value gaps as far as I can, because I want to see when the imbalance is going to be completely filled, not when it's just going to be touched, because that means nothing. If whenever a fair value gap gets touched, that just means it's been touched. What price wants to do is it wants to fill those fair value gaps on each side. So it fills it here, right? Hits this one, fills it on this side, and it touches this one up here, and then comes back down. Here's another fair value gap. It fills, boom, boom, and that leaves us to where we were today. So it falls back down into this 4-hour fair value gap, which, as you can see, was left open right here, wide open, and also with a bearish or a bullish order block. So a bullish order block would have been your last bearish candle before your next bullish candle closes above it. So I already have it marked there with the white. So it comes down into that area. And I'm looking at the 4-hour. So it drops down into the 4-hour fair value gap about halfway into it. And then boom, rockets up. And then after it rockets up, once we drop down, I mean, it does have the 1-hour fair value gaps here that I have marked, right? So we drop down to the 1-hour, and it hits this bearish order block, right? Gets rejected there, starts pulling back, and now the question is, where is it going to go from here? Well, it's already fallen into the 4-hour fair value gap. I don't think it's going to fall back down and try to fill up the rest of it. I just don't. And if I were to hit the eye here, yep, it looks like all of these candles here have been except for this one, they have been, oh, come on now, balanced. Everything has been balanced except for here. Right here is a fair value gap, right where that bearish order block is. So I wouldn't be surprised to see it fall back into this fair value gap, maybe even a little bit further. It could fall back down to the top of this, the top of the first of the red candles, right? Because that would be your bearish order block, or your bullish order block. I'm sorry.